We are now joined by Mr. Sanjay Kumar, Managing Director at Indraprastha Gas. Good afternoon, sir, and thank you so much for making time. Before we come to your numbers, let's start talking about the new announcement that has come on the gas allocation policy. What does this mean for IGL and how does it benefit your company?
See, for last many months, we were getting supply to the tune of the CGD sector in the country was getting gas supply to the tune of 17 to 18 million cubic meter per day from GAIL for DPNG and CNG sector. Now, that was becoming a stumbling block for the growth of these important, sector for the CGD industry. The government has allowed GAIL, the gas supplier of for CNG and DPNG sector, to mix RLNG in this 17 million or 18 million, whatever gas is available from ONGC and OIL, and then supply to the different CGD consumers. So you may be aware, government has the vision of increasing the gas consumption in the primary energy mix to 15%. Now that would not be possible if there are these restrictions on the gas supply quantity. So what has happened is that by allowing a mix of RLNG or the other MDP gas from domestic fields, government has now increased the scope of gas supply for CGD companies. So in 10 years, if there is a vision of increasing the 17, 18 million cubic meter gas consumption in CNG and DPNG to say 75 million cubic meter per day or 100 million cubic meter per day, that can only come from mixing of RLNG or other domestic MDP gas. So this is a very important and landmark policy decision by the government, and we welcome that. As IGL, we believe that this will help the CGD sector to grow.
What was your gas sourcing cost before May 16th, and what is the gas sourcing cost now that the policy has been kicked in?
So there is not much change. The average gas sourcing cost was whatever it was earlier. It has remained within 3-4% plus or minus of that. We can't give specific numbers.
Okay, so petrol and diesel prices, though they have been unchanged for over a month now, but they're still at record levels. Now, without any doubt, CNG is cheaper, but that has resulted into higher conversions for you or not? What are the trends that you are seeing on the ground?
So last year, around the same time, we were looking at about 8,000 vehicles converting to CNG, but now that number has gone up to 16, 17,000. We are seeing long, waiting period for CNG vehicles, the new vehicles. So we believe that market continues to be there, and it will help us in growing, as we have been growing in the past also.
OMCs have been asking for higher margins, and the matter is still under discussion. What is the current margin that you are paying, and how much are they asking? And according to the pricing, could this settle? Has this been one of the key overhangs on the stock price?
So we have had one discussion already, very senior level discussion on this recently, and we hope to conclude this matter in this month or within next few weeks. It will be better that we talk about that later.
Okay, so where do you expect to maintain your margins as far as FY23 goes? Are they likely to improve from here?
So we have been maintaining my EBITDA margin of between 7 to 8 rupees per standard cubic meter. And we expect to maintain that this year also. Our volumes are likely to grow by 20% approximately.
So if the raw material prices will increase, will you take price hikes to maintain margins?
That has been going on. If you look at the past trend, we have been maintaining EBITDA margin of rupees 7 to 8, between these two levels. So what I'm indicating is that we will be around these levels this year or next year also. Uh, we are going through a big, commodity crisis all across the world. The prices are likely to stay high, and the differential in the pricing of alternate fuels may continue to be like this only for coming many quarters.
Okay, sir, we let you go on that note. Thank you so much for making time and speaking with ET Now.